How's it going, everybody? My name is Antonio, and I'm on the barbecue today on August 29 with Frederick Bell, the CEO of Elemental Altus Royalties, which is, as you might guess, a royalty company with assets on plenty of assets on four continents. Who's not here today with us, though, is your financial advisor. This is going to be a casual talk between two people who you likely don't know, and you don't even know if we're real humans or AI. So for as far as you as a listener or viewer are concerned, this is going to be a conversation that's general and impersonal in nature, as well as a conversation that will include no financial nor professional advice of any sorts. And it's also definitely not a conversation that you want to use as independent research, because it's going to include what are called forward-looking statements, and probably a lot of them too. Those are statements about uncertain events that may or may not happen in the future. There's a warning on your screen right now, so please take the minute to pause the video and read the full warning. Because the mineral exploration, development, and mining industries are among the highest risk industries out there. So failure is often said to be the norm here. So please be careful with that. And if you care about money and you don't like losing it, do more research by visiting the company's website and analyze its official filings on setter.com, as well as consult a professional investment advisor before taking your own decisions in the end. That out of the way, Elemental is a $220 million Canadian company that's trading at about $1.20 per share, Canadian that is, of course, which means that they're about 185, give or take, million shares outstanding. Those shares trade on the TSX Ventures Exchange under the ticker symbol ELE, where an average of about 31,000 shares have traded during the last 90 days. I am looking at a 52-week high of 153 and a 52-week low of about $1. About 77% of this company's shares, though, are tightly held by management and board, as well as institutions, with the most notable shareholders being the La Mancha Resource Fund, which is was a rather famous resource fund. It's a fund based out of London. And then there's about 11% of the company that's owned by the actual management and board. And the rest is spread between a few institutional shareholders. You might be aware of MJG Capital. Matt writes it up every time in his quarterly newsletters. And then again, that would result in about a 23% retail, I'm assuming. Now, at the end of last quarter, Elemental had almost $11 million in cash, an almost $4 million public portfolio, and a $30 million debt. Elemental was founded in 2017 and became Elemental Altus after its merger with Altus Royalties in 2022, which today has resulted in a portfolio of, I believe about 70 or so royalties, but the more important part, 10 of which are already on producing projects. So this is what is spread across a total of 15 jurisdictions and so 4 continents. Two of the, or actually, let's do three. Three of the largest contributors to the company's top line are, number one would be the Caserones mine in Chile, which may sound familiar because the Lundins bought 51% of that mine for almost $1 billion earlier this year. And the Lundins are, by the way, now also its operators. And so Elemental here owns almost 0.5% royalty on this rather large mine. Why I'm saying it's rather large is because as it sits today, Caserones has been operating, by the way, for 5 years. So that's 5 out of the 17 in total years that are estimated for the life of mine. And but so the LOM production is estimated at 148,000 tons of copper equivalent. So that's why I'm saying it's large. This is made of this is actually made mainly of copper, of course, but it's also a little bit of molybdenum and so also some fine copper in cathodes there. That aside, then the second largest contributor to the revenue here for Elemental is the let me try and pronounce it. Karlawinda. No, it's not as hard. I thought it would be harder. Karlawinda. That's a gold mine in the Pilbara region that's in Australia, Western Australia to be specific. And the company's bought a 2% NSR royalty on it back in 2021. And then the third one, this is much smaller than a previous one, but the third one, and then I'll stop, I promise. But the third one is the Wagnian mine, if I'm saying that correct. This one is operated by Endeavour Mining, and it's located in Africa, specifically in Burkina Faso. Very close to the Ivorian border, so that'd be in southern Burkina Faso. And so Elemental owns a 1% NSR royalty on it, which has already resulted in over $1 million in proceeds from it. And so together you have the, as I said, Caserones, Carla Winda, and the Wagnian. They make up over 80% of the company's revenue, and the first two make up about half of that. And they, by the way, total revenue is forecasted to reach between 16.2 and 18.4 million dollars in 2023, with 80% attributable to gold and about 20% attributable to copper. Having already reached a total adjusted, and adjusted is to be noted here, but so an adjusted revenue of $8.5 million at the end of the first half of 2023, and that's also resulted in a it's resulted in a net loss of $3.4 million, but it's an adjusted EBITDA of $5.6 million. Other than these three, as I mentioned, the company has plenty of other producing and non-producing projects, 22 of which were added in 2023 alone, and we are, it's basically halfway through, and many of them are believed to offer a lot of exploration upside next to the, of course, the revenue upside for the company and the other projects. So we're going to be talking about those, but my wife's told me that I cannot be the center of attention in any conversation, so it's probably a good idea for me to shut up now and welcome the CEO. So, Mr. Bell, thank you for investing your time with me, sir.
Hi, Antonio. Very pleased to be here. Thank you.
Pleasure is all mine, of course. I'm looking forward to this conversation. What am I missing here in the overview? There's quite a lot to be talking about, so I don't know what am I missing of the important stuff.
So maybe just 2 points to add. I think that our primary exchange you mentioned is TSXV. We're also traded on the OTCQX in the US with the ticker ELEMF, and so that probably trades an equivalent volume to Canada again. And I think actually quite often the US, sort of the center of gravity of liquidity, often moves to the US because of the bigger market. And then maybe also just worth pointing out, earlier this year, the sale of the Wagnion mine from Endeavour to Lilium Mining, which is run by an ex-Endeavour, somebody on the ex-Endeavour management team who bought 2 mines from Endeavour in West Africa, and one of those is Wagnion, where we have our royalty. But otherwise, I think a very comprehensive overview, and really sets the scene of a royalty company in our position, which is, we're still incredibly small, early stage, 200 million market cap, but we've put together a portfolio of predominantly producing assets. And I think this year is the first year we're really starting to build out, not just the producing assets, but started to build out the development pipeline, exploration pipeline as well, which is why we've been so active in the number of deals we've done, and why we're going to continue to be going forwards.
Well, you say small, but then again, you already have revenue, and there's the royalty business model has become extremely popular in recent years, and so there's quite a lot of companies out there that just have basically a portfolio of dreams, as they call it. So that's a difference. What do you notice? You're noticing the same thing?
Well, it's yeah, I suppose it's all perspective. When we started the company, it was $1 million valuation, and $1 million fundraise, and we had to give away half of the first royalty we were acquiring because it was $2 million. So we bought half of it, and we syndicated it with a PE fund who bought the other half for $1 million, and I think that was done at approximately 27 cents equivalent. So yes, small as relative term. I think if you'd said to us then we'd be here today, we'd be very pleased, both in terms of share price and in terms of the market cap and the portfolio and diversification and what we've managed to achieve. But I think it's a advantage and the danger that you constantly reset your expectations. And so yes, when you ask the question now, we look at it and we think, okay, we can grow an awful lot from where we are, and we've done some of the hardest part in putting together a royalty company, which is getting to this stage where we do have a really diversified portfolio, and we have a very strong asset base underpinning the company.
So you started this in your very early 30s, if I'm not mistaken, and then you started as a very tiny company, as you said, well, relative to now, not a super tiny company, of course, relative to my companies or something like that. So it's still a big company, but well, that's scary. I mean, were you scared?
Yes, I think leaving we actually it's with someone called Richard Evans, who I'd worked with in 2010, and he was co-founded Elemental, and which merged with Altus and Elemental Altus, and Richard's been really our lead technical all the way through Elemental Altus through to today. And I think we were been talking to him for a while about doing this, and I had another job at the time, and I think it got to the point where he said, you can't just keep talking about it. You actually need to do something. And I realized that if we were going to seriously do it, I probably need to quit my job and do it full time to give it the best shot. So I think that was probably the scary moment. But I studied history at university. Before we did this, I definitely did a lot of reading on the royalty space and the history of the royalty space, and looking at previous companies and what approaches had been successful and what companies had been successful, and how they had done it. And through that, we came up with a really clear strategy to focus on, I think, initially third-party royalties, where we could get good value and good opportunities outside of competitive processes, but also where we could focus on producing assets at the outset to get positive cash flow, to keep a tight shareholder base and grow it privately to the point where we could take it to list. So it was I think a dive into the deep end, which is always required when you're setting up a company from scratch, but given some comfort by the familiarity with the royalty space and the knowledge and experience that we'd had as a team up until that point in the mining industry.
But I guess, as I mentioned, started in 2017. So I guess almost bottom ticking the market also helps at times, though. So you've been very active, though, since. So all the credit for that. And you've been very active this year alone, as well, as I mentioned. Are you planning anything? Are you planning a whole lot more? I know you're planning something for H2, but are you planning a whole lot more to be coming for H2, or is that going to be a calmer period?
We always seem to say it would be a calmer period internally. And I think it never ends up being that way. So I think looking ahead to the rest of this year, 2023, we have quite a lot going on. So I think even without new opportunities, which always come up, I think we're expecting it to be a very busy year. And just to recap, we closed the merger with Altus in August of 2022. In December, we announced a new credit facility graduating from Sprott Lending, who had been very good getting us from a private company through the listing, helping us make some really material transactions. But we graduated up to the big banks, National Bank and CIBC, and that gave us a larger credit facility and lower cost of capital. And on the back of that, we've announced some transactions partnering some of our generative portfolio. That is projects we fully owned in Ethiopia, in Mali, and then most recently in Egypt, with really good quality groups who can finance those through the next stage. So we've essentially outsourced those projects and that ongoing cost in return for cash, royalty, interests, and then we've also been active acquiring a number of royalties, both exploration, early stage, advanced exploration, brownfields, former mines, and also royalties on producing assets. So it has been a whole mix since the merger in terms of deals done, but it's been, I think, really satisfying. And you touched on there the market conditions when we started Elemental 2017, and it was a tough time in the market. And I think that if we look around where we are today, there's a lot of similarities. Not in every sector of the mining industry. There are some commodities and some areas that I think are still relatively strong, but certainly in the precious metals gold space, the market has definitely come off, and it's come off for a lot of projects and a lot of companies, sort of irrespective for some of them of the quality and where they're at. So it is a not dissimilar market today. The big difference is that we have cash on hand, we have positive cash flow, we have ongoing royalty revenue to reinvest, and we have bigger supportive shareholders and a credit facility that we can use to take advantage of the market conditions where we are today.
I often hear, and when I'm interviewing CEOs as well, they would tell me something along the lines of these market conditions in terms of volumes and whatever, they look quite a lot like the bottom was in like 2015, 2016 and so on. But now the price of gold is much stronger than that. And sure, I mean, there's nothing to argue there. But at the same time, operating conditions have changed quite a lot on top of geopolitical troubles, which have resulted in inflation and all that, and so on and so forth. Like, sure, the gold price is quite a lot higher, but if you look at some of the operational performance of some of the big boys, a lot of them are struggling. Newmont made a huge M&E, and it's just financially they're still kind of struggling to pass through the results. So that's one point. But at the same time, you also have some royalties in some of the challenging jurisdictions, like Ethiopia. Mali is now Mali is right next to Niger. For people who don't know, is to the west of Niger. And so well, you seem like you might want to divest or not from some of them. You can talk to me about that. But at the same time, those jurisdictions now, they do offer very, very, very cheap opportunities if you look at some of the stages of the companies that are there. So I can imagine you're obviously seeing that. So can you talk to me about how you really think about jurisdictional risk, and whether you'll be focusing on sort of divesting from those jurisdictions and focusing on safer jurisdictions, or are you going to be going sort of for the cheapies in the riskier places?
So I might break that answer into two points there, which you raised, and the first one was around the risk factors and the changing environments, and the fact that despite the gold price having risen, actually a lot of equities have really struggled. And I think the key cause, and you mentioned the word there, is really inflation. And you saw this in the first mining boom and I say the first mining boom, I should say the first mining boom since I've followed the mining industry, which was in the early 2000s. And in that boom, you had commodity price increase that was very material, but you had associated inflation, and you had inflation in salaries, you had inflation in costs, and a lot of the primary costs that feed directly into mines, and that eroded a lot of the margin that seemingly at the top line you see in commodity prices. And I think that's definitely been a factor again, where you've seen across the board increase in costs for mining companies because of inflation. And that has eroded some of the increases in commodity prices that otherwise would have driven margin expansion and all those other positive benefits. Now, one of the key advantages of a royalty company and royalties is generally speaking, our royalties are top line revenue. So we are protected against that inflation. And that is a key feature that is really important. But secondly, on the other part of your question, which was around geopolitical risk and around certain countries, I think the way we have always looked at it internally is that you don't know where you will have issues, and you talk about countries and talk about regions within countries and even communities within regions within countries. And if you look at Mali, for example, it's a huge country, it's a landmass, and you've got almost two distinct regions within that. You've got the north and the east, where a lot of the instability is, and you've got the western border, which is where nearly all the gold mining is, and significant differences between that. And so there are nuances between the countries themselves and where they are. And an interesting fact that someone told me just recently was that I think in West Africa and one or two of the adjoining countries, there have been 70 coups in the last 50 years. And I was told that fact in the context of a mine that had continued to operate in that region for that most of that period. And so highlighting the fact that even though there are changes of governments and coups and political instability, actually, vast majority of the time, the mines continue to operate because they provide a very important contribution towards not just the GDP, but the foreign exchange as well for those countries. And so I think for us, it's about being diversified. It's being diversified across countries. It's being diversified across regions, even within those countries, and also different operators. And geologically, one of the ways we have looked at it is that in some of these emerging countries in South America and in Africa, you get exploration potential that is far less explored. But you have to balance that with political risk. And sometimes in places like Canada, some of the more mature belts, or Australia or the US, you get regions that some of the easy resources and easy ounces in terms of gold have been mined, but you're working within a more stable environment. And so we've always felt like if we can balance those, where we're getting some royalties on opportunities that are very underexplored, and they'll be exploring there for decades to come and have seen no modern exploration. And if we can marry that and blend it with opportunities that are in the Australias and the USs and the Canadas, it gives us a very good blend in our portfolio of risk across geological risk as well as political risk.
Sure does. But then it's sort of making me think to the comment that I just made about you potentially or maybe wanting to divest from some of those assets. And what I'm alleging to here, obviously, is DIBA, because you sold it for, was it 6 million cash? And then some, how much again are you expecting to get on top of that?
So the major value driver in the sale of DIBA Camflet is really the royalty. And we have a 3% royalty on the first, just over 220,000 ounces, and a 2% royalty on the resource following that, uncapped on the licenses. And there's a bit over a 600,000 ounce resource there as is. But what's really appealing with it is as well as the up to $6 million in milestone payments and cash payments there. But I think what is appealing for us is that the operator who acquired it, Allied Gold, they're in the process of listing in Canada at the moment, and their mine adjacent to it, Sadiola, is about a 10 million ounce resource historically. So it is a major asset. It's been producing a long time, and some of the resource that we had, the oxide in particular, is very easy to mine at their mine. And so for us, it was a case of, look, they're better positioned than us to explore it. They have the intellectual knowledge and IP accumulated over years and geology and understanding the area. They have their own exploration team and drill rigs on site. And also their plan is to, and they've said this, their plan when they acquired it, they said their plan is to mine it essentially as soon as possible, starting next year in 2024. And so roughly speaking on their mine plans, between the royalty and the cash payments, we're probably looking at order of magnitude of $15 million to the end of 2025 from that asset. But that's without exploration, that's without mining any of the resource beyond that 220,000 ounce approximate initial area. So I think for us, it's putting in the hands of a good operator established in Mali. They've been operating in country, they understand how to do it. And that's also very helpful versus us. So it's putting it in the hands of a good quality operator who can actually explore it, and we can get uncapped upside to that, but also delivers a very tangible gain to us over the next 18 to 24 months.
Is that also is that jurisdiction dependent though? And does your way of thinking apply to Egypt as well? Because you seem very active there, and if my gut feeling is right, I mean, you're looking to get even more active on because you have 100% owned ground in Egypt, if I'm not mistaken. So
we actually, and I should say this, we just announced within I think the last 24 hours the partnering of and really sale of a majority stake in Egypt to Into Metals, and that is a vehicle beneficially owned by the Sawiris family, who are the largest shareholder in La Mancha, who are our largest shareholder, and it's one of the richest families in Africa and in Egypt, and they have a long track record of investments across the continent. They're Endeavour Mining's largest shareholder, and that is a top 10 gold miner globally. So very active, not just in mining, but across different industries, and they have we've just announced a deal with them where they will be taking up to 80% of that local company, and we will get cash payments up front, and we will get royalties, and they will be operating it and investing in it going forwards. And for us, again, that is putting the projects there, the formerly 100% owned projects, it is putting it into really strong hands locally, who understand mining. They are financially very well backed. Technically, they're extremely astute, and they've got a very good team there. Again, some ex-Endeavour people on the team. And so for us, where we can partner up, and we've done this now in Ethiopia, in Mali, and in Egypt, when we can partner up our 100% owned projects with really good quality partners, and that's really good technically, and really good financially, which is important in the current market environment, they can advance those projects at no further cost to us. We've essentially outsourced investment in it. And I think our sort of internal budget for royalty generation over the last year has been approximately $2.5 million US. So we are essentially outsourcing that investment to partners. We'll be getting up to the end of 2025, approximately $15 million in cash and royalty payments. We'll be having carried equity interests, and we've got uncapped royalties over all of those licenses. So that's partly how we have addressed that side of it.
Is Into Metals not a public company? Is that going to stay the case, or
it's funny? Yes, didn't expect this, but the transactions we've ended up doing in Mali, Ethiopia, and Egypt have all been with private companies. Now, albeit Allied Gold, it's announced that they're listing the company, so that is pretty imminent, and I believe from public announcements expected in September of this year. But it is the other two are still private, and no transactions announced to go public, and that might be partly a reflection of individual circumstances. It might also partly be a reflection of the current market, where, to be honest, if you've got the financial backing and you've got good quality people behind the company, sometimes it's actually better to stay private and advance the projects quietly and efficiently without some of the bureaucracy of being a listed entity, and then you can take the company public at the right time. And I mean, that's what we did with Elemental originally. Elemental Altus is we stayed private for a few years and built up the track record and the assets to a point where we could list a company and hit the ground running.
Where I'm coming from this is because this is looking at the news release here. This is Intu's first investment in the country, but with the influence of the Sawiris family, I'm assuming they're going to be able to move quickly, and so capital is going to be spent quickly. And so that's where I'm sort of coming from and asking whether you think they're going to have to go public, or whether they're, looking, or whether, yeah.
I can't speak for Into directly, but I would guess that their priority is focusing on the ground and exploration, and that will probably dictate the future steps for them and in what direction they go. But they are very fortunate to have the backing of the Sawiris family and the ability, I think, to stay private if they so desire, which most companies in the mining and particularly the mineral exploration industry don't have that luxury. So for us, it was an important part of the process in reviewing partners and groups we could work with in all three of those countries, was, do they have the ability to invest in the company and in the ground going forwards? And for some of those projects, it was incrementally more expenditure, but for some of the projects, it was substantially increasing expenditure. And so it was really important to partner with groups who we believed would be able to do that irrespective of market conditions. And I think we believe that all three of those groups can continue to advance those projects expeditiously in good markets and in bad.
It seems like a comparable deal, not exactly, but it's close to what you've done in Ethiopia with ANS. I suppose. What can you tell me about that there, by the way? What's sort of the plan moving forward with that one?
So ANS, a private company focused on the Arabian-Nubian Shield, which is where the name comes from, and some of the technical team there are familiar to us, as are some of the senior management team. And so that was a deal where we had a lot of confidence in management to execute and to be able to advance the projects and make a decision. So from our perspective, I think, again, very similar thesis, which is partner with good quality groups and good quality people, and allow them to advance the project through the next stages when we have taken some of the initial risk and taken the initial work out of it, and we've identified good prospects. And something I should emphasize as well is, I think, the fact that we've been able to do these transactions with Allied, with ANS, and with Into Metals is a testament to what the team have done in terms of putting together high quality targets. And these aren't necessarily the first projects they've come to. I think it's been a process of elimination of working through and really narrowing in and honing in on the good opportunities and being able to attract good quality partners in here is a testament to the projects and the quality and potential that they have going forwards.
Okay. Africa is, again, as I said, an interesting place to me right now, and especially the ANS, as in the Arabian Nubian Shield. It looks like a lot is brewing there, and I think we're going to be hearing a whole lot more about it in the future. Sort of my personal gut feeling is telling me if that's worth anything, which it probably isn't. But what do you have? You have Burkina Faso, you have Cote d'Ivoire, you have Mali, Egypt, Ethiopia. Are you looking to sort of expand your footprint in Africa specifically, or is that not necessarily how you look at royalties? You look at it more on a bottom up perspective, as in, does this company and does this project make sense, or do you also focus on jurisdictions?
So I think our portfolio as a whole now, by net asset value, is about 75% weighted towards OECD countries. And so I think in terms of Mali, Cote d'Ivoire, Burkina, some of the assets you mentioned, particularly some of the smaller ones, I think it's not that material to our overall portfolio. And so we've always been trying to be opportunistic, keep an eye on the balance of jurisdiction and the balance of the assets and commodities and operator exposure. But we've tried to be opportunistic, and where we see good opportunities, whether that's from a technical perspective, sometimes it could be from a commercial perspective, we've tried to have the flexibility to be nimble and agile and take advantage of those. And so that might well mean that sometimes we're overweight Australia, or we're overweight Ontario, or we're overweight Chile, or we could be overweight a lot of countries and places and even counterparties. But I think our view is that in the long term, as we continue to grow the company, and it wasn't so long ago that I think our revenue in year one was sort of close to $400,000 versus the 16 to 18 million rough guidance we've got for today. So I do think that if you'd looked at us on day one, we would have been, what were we, roughly 100% revenue from Kenya, probably sort of 70% of net asset value in Kenya. And if you look at us today, it would be sub 1%. On those. So you can definitely, one of the advantages with the royalty company is that as you build out the portfolio and as you're also simultaneously scaling up, you can actually continue to diversify in terms of your exposure as well. And I think for us, having gone from 400,000 revenue in 2017 up to sort of 16 to 18 million today, gives you a sort of I think a view of the sort of the scale of growth that we've achieved, and that is probably equaled in terms of jurisdictional exposure and weighting towards different countries as well. So for us, we definitely see the opportunity in continuing to be agile and flexible and take advantage of opportunities where we see them.
Do your diversification plans include diversifying into other commodities as well? Because you're now 80-20 gold, copper. Are you looking into something else potentially?
It's a good question, and I think that we're keeping an eye on it, and it's a very interesting question as well as to I suppose for the royalty space, which is when I started looking at the royalty space historically, the vast majority of companies were precious metals focused, and there were really only one or two outside that. And if you look at it today, you've got a specific lithium royalty company, you've got a specific uranium royalty company. You've got a company that isn't in the name, but is effectively an iron ore royalty company. So you have seen this schism into commodity-specific royalty companies, as well as the precious metal space. And then you've got some battery energy, battery minerals, and energy-related royalty companies. So I think you can afford to be broader in perspective of commodities now. And it's always an interesting aside to think that the biggest royalty company there is, Franco, when they relisted in the mid 2000s, coming out of Newmont, I think they were, I'll get the numbers wrong, but it was roughly order of magnitude 50% precious metals and 30% base metals and 20% oil and gas. It was some sort of mix like that. That was a lot. It's not what I had expected looking back on it. And I think that today you can probably mix it up a bit. That said, we've always been quite heavily precious metals focused. We understand gold, we understand the industry. I think a lot of our investors like that as well, that gold weighting. So we're definitely looking at other commodities, and copper has been a good example of that, where we've got some royalties on some really long life generational copper assets that I think blend into our portfolio really well. And putting that alongside gold that we've already got a lot of has been quite complementary.
Yeah, I can imagine that makes business sense as well, focusing on the larger mines, which are often, as you said, copper mines or base metal mines generally. Because uranium is obviously interesting, and those mines are very valuable on a per ton basis, but they're not often very large. And I imagine it'd be hard getting an ISR in some of the Kazakh mines, or like on Cigar Lake or something like that. That'd probably be challenging. But well, one way that I guess you could get access to some of these mines, to royalties on some of these mines, might be M&A. So that might be a good segue into talking about that. What about more M&A in the royalty business specifically? I mean, I know you've had your brief encounter, which probably didn't seem too brief to you, with a hostile takeover a couple of years ago. But are you planning any M&A yourself?
Well, we're not planning any hostiles. I can tell you that. But we look, it's if you look back, take the broad historical view on the royalty space. I think in 2013 to 2015, in that period, there were probably about 10 M&A deals which consolidated the royalty space. And if you fast forward through to 2020, there were approximately 10 new royalty companies created in 2020. And that was the peak number of royalty companies. And since then, we've had 8 M&A deals consolidating the royalty space. And our expectation is that will continue. And over the course of 2023 and 2024, there'll continue to be M&A deals. Now, where those will be, what companies those will be, that's the difficult question to ask. But I think it's certainly the opportunity for further consolidation is there. There are in the royalty space, it's a well-known fact that you can scale up the company significantly at a certain point, and your team and management team can stay relatively the same. So you can have that increasing margin, and you can have much greater exposure to assets, and those economies of scale can be very helpful. So I think further M&A and consolidation is very likely in the royalty space. It will be interesting to see who it's with. We obviously had our own merger with Altus, which closed in August 2022, and we've just had actually the 1-year anniversary of that. So we've been through it ourselves, and it is very interesting perspective when you go through something like that, and you look back at what your assumptions were at the time of the merger in terms of the assets, and then you look at where they are a year on, and there are assets that we thought would really sort of have the potential to outperform, and we thought there were assets that we probably didn't attribute as much value to, and some of those have inverted and been the other way around. And it just shows that even in a small space of time, in a year, you can never quite tell which asset will be best and how they'll go. And there are obviously some really quality assets in there that have been excellent performers, and I think will continue to be. But in the wider portfolio, and now having over 70 assets in the portfolio, there have been some really good assets in there that we probably didn't attribute any value to. And I think going forwards, we will see a lot more value come from. So it's certainly highlighted the potential value in consolidation for us personally. And I think that we said when we merged with Altus that we both viewed it as potentially the first step going forwards, and would keep an open mind to further consolidation if it made sense, and where there are opportunities. And I think that broadly still holds true going forwards.
Okay. You made a point there that you could, grow the company without growing the G&A too much. So I do want to talk about that here in a second, but let's maybe sort of close off the operational discussion before we move on to the financial discussion, with you sort of giving me an overview of what else, step by step, of the things that are going to happen this year. What are you doing specifically?
So I think that in terms of what we've announced, we have the latest deal we just announced was the sale of the majority stake in At Gold, our Egypt subsidiary, and that closed on the same day. But we have the sales in Mali and in Ethiopia; those we still have to close. And we also just announced in the last week the acquisition of a royalty on Arizona and Sonoran's Cactus copper project in Arizona, and that as well to close. So we've got 3 transactions that are coming up that we need to close. I think you can continue to expect us to look at ongoing acquisitions across the portfolio. And we've also got 1 or 2 material events in our portfolio. And that is probably 2 assets. One we have a stream on and one we have a royalty on. And that is the Ming copper gold mine and the Ballarat gold mine in Canada and Australia, respectively. And both of those have been going through sales processes that will come to a conclusion in the second half of this year. So it's been quiet in the background. We haven't been able to say much for the last, I suppose, going on 6 months. But both of those should be coming to conclusion shortly. And also another royalty that will become a lot more material for us in terms of cash flow is the Bonikro royalty that is ramping up from the royalty area. And that is a part of the mine that our royalty covers in the second half of this year, and probably even Q4 rather than Q3. So I think we're expecting that royalty to start to become much more material for us from probably Q4 onwards. And that then will be one of our larger producing assets. So that's a few of the, I suppose, highlights that we're flagged and are known that are coming in the market over the rest of this year.
Okay. Well, you're going to need, it all sounds nice, but you obviously need money for that. So that might be a good segue into talking about money, because your bottom line is still not in the black. Matter of fact, even though revenue adjusted revenue, well, total revenue and adjusted revenue have both really gone up considerably, the total loss has sort of stayed the same. So when do you expect you're going to turn profitable?
Well, I think the key thing here is that with the merger with Altus and Elemental, we took on the exploration royalty or the generation portfolio that I mentioned earlier, and I think we budgeted sort of $2.5 million a year on spend on that. And so with the recent deals announced in Mali, in Ethiopia, and in Egypt, we've effectively outsourced the vast majority of that expenditure to partners. And so there's teams that have gone with some of those sales in country and ongoing costs. So I think that from that side, we're obviously working to close those transactions now. 2 of them at least that are still there, but that will reduce substantially our expenditure on royalty generation going forwards. So that will make a material difference. And then with the increase in revenue that we're getting at the same time, I think you should really start to see increase in margin there as we go forwards. And I think it's also important to note that we are actually cash flow positive in terms of in accounting terms, after you take account of depletion and you take account of investment in the projects. But when you look at it in pure cash flow terms, we're cash flow positive, and we have been for the majority of the history of the company. And so I think for us, what we should see is with increasing revenue going into the second half of this year, and also decreasing costs through the outsourcing of a lot of the expenditure on the royalty generation portfolio, that will have the dual benefit of increasing our margin. And so that will become more apparent in the second half of the year as we go forwards. And that's really important, because in this market, you sometimes see, you mentioned it earlier, you sometimes see good opportunities for new royalties. And the challenge is how you raise the money to buy them. And so the more free cash flow we can have, the more money we can have from producing royalties to recycle into new opportunities, irrespective of the market, the better that is. And we're in a fortunate position where 2 of the transactions we've done this year, 2 of the acquisitions we've done, the counterparties we acquired royalties from, both took equity in the company. One of them took 100% equity, and that's RCF Opportunities Fund, very well known private equity fund in the mining industry. So delighted to have them as a bit over 5% shareholder in us, and the other was part equity, part cash, and that's something that I think is also helpful, where we have attractive equity and where counterparties can see the upside and the value in it, and that gives us an ability to do more transactions as well, which is, I think, what you want to do in these kinds of markets. And if you look at our history from when we listed in 2020 through to sort of the end of 2022, I think we did 2 material transactions in that period. And if you look at it from the beginning of 2023 onwards, you mentioned we bought a bit over 20 royalties, and a couple of those have been material transactions. So we've been a lot busier, and that comes down again to the philosophy, which is when equity prices are high, when valuations are high, you want to exercise caution and be disciplined. And when the market is weaker and there are, I think from our perspective, better value opportunities out there, that's the time to be more aggressive. And it sounds simple, but it's a lot more challenging in practice than it is. And it also, the crucial ingredient required is the cash to take advantage of those opportunities. I think a lot of people can probably look back, forget the mining industry just generally, look back to the GFC in 2009 and 2010 and say, wow, look at all those great businesses that were effectively on sale by 30% or 50%. But, you know, it required cash and liquidity at the time to be able to take advantage of it. And so for us, that's why we focused on building a really resilient royalty company with diversified revenue, so that we can continue to invest no matter what the market conditions are. Maybe we can't invest as much as we wanted, but we can continue to invest even through the worst parts of the market. And that enables us to be opportunistic and take advantage of opportunities when others can't.
So obviously I like hearing what you're saying here, which is more revenue, less expenses, fatter margins. G&A though has doubled since the transaction with Altus, almost doubled basically. So is that something you're going to be, I mean, is that what you're going to be trying to reducing, or is that not, I mean, is it not feasible to work on it?
No, that's a good question. And I think we didn't break out in our accounts the sort of breakdown of G&A, but that includes the spend on royalty generation.
Okay.
So within that number is $2.5 million on royalty generation that we have effectively we've been doing since the merger, and that's why the pre-merger number from last year and the post-merger number looks a lot higher, because we've on an annualized basis we've taken on that expenditure, and we've just, with the last deal being announced in the last 24 hours, so fresh off the sheets for this interview, we've just announced we're outsourcing that. And so for us, it's, I think our philosophy here was, some of these projects, the next logical stage is drilling and more drilling, and it starts to get not just incrementally, but a step change more expensive to do that. And so we had a choice then of either not spending $2.5 million a year on it, but ramping it up to $5 million a year expenditure, or we can find really good quality partners with deep pockets and really good technical teams. And in the case of Allied Gold, and real synergies in terms of a mine next door where they can actually start mining within the year at some of our licenses. And for us, we can retain uncapped upside in all of those projects. We can monetize some of them now, and we can de-risk it. And then going forwards, we have a G&A and cost base that is substantially lower.
One of the reasons why I like seeing M&A in the space is because I'm of the belief that we have too many companies and too much G&A relative to the exploration spend, and definitely relative to what that exploration spend is resulting in. That's one of the structural problems really in the industry. But so if you took if you looked at both companies and sort of the salaries there, now that you've merged those two companies together, how much do you think you've cut the total salary spend by?
And maybe just and just as a first part of the answer to that, I think because it's important you touched on it, which is sort of how much of the capital raised in exploration goes actually into exploration. And that was part of the attraction with groups like ANS in Ethiopia and Into Metals in Egypt, was that they're private companies. They don't have the overhead costs that a listed company has. You don't have to maintain all the advisors and to do it to that level. So for us, it was attractive as well because they're able to be more efficient in their allocation of capital. Now, it makes it much more challenging for them to raise money in the first place, but those are teams and groups that are really well backed and we're confident they can do it. So that was an assessment for us as well when we were looking at partners, was not just how much money they can raise, but if they can raise the money, how efficiently can they allocate it into the projects and into exploration? Because that's where our upside is in both those projects, is in the exploration upside. And then the main thrust of your question was on G&A, and it was on how we are. If you could just repeat it, I think it was how we have adjusted G&A from
salaries specifically.
Yes.
I mean, in terms of personnel, because the attraction here is that as a royalty company, you can have exposure to a bunch of companies, a bunch of projects for a limited salary cost, basically.
Yeah. So we used to outsource our accounting team and legal team. And so if you look at us through the merger, I think our highest cost was external legal advisors because we didn't have a GC in-house.
Yeah.
If you could go back in time and you knew the hostile was coming, would have been a lot cheaper for us to hire someone internally in the company and manage that. And so with the merger, we actually added a few new people. So we have a full-time in-house CFO. We have a full-time in-house general counsel. So we've actually added a few new positions internally which should mean that going forwards, we have lower external advisors, third-party professional costs. So I think for us, it was not just really a focus on reducing G&A at a top level in terms of the management team, but it was actually in strengthening the skills of the management team so that when we're going forwards, if you're looking at us today as a company, we could do substantially larger transactions and we could have substantially more assets in the portfolio. And this is a core of a management team that could run a company double the size of ours, I think pretty easily. And you couldn't have said that about us prior to the merger. So I think prior to the merger, there were really 5 of us full time in the office, and it had been 4 just shortly before that. So it was a very, very lean team. And I think that for us coming out of it, we needed to add a bit to the management team in terms of in depth and also as a bigger company. There's been a specific example that's sort of highlighted it for us, but also cover. And you have key personnel risk in small companies. And one of the things that we've tried to do with the merger is make sure that we're more resilient, not just in terms of our asset base and our revenue base, but we're also more resilient in terms of our management. And so, if one of us suddenly needs to stop work for some reason, we're better placed to be able to cover that and keep the company going in the same speed and the same direction that it was before. So I think that's how we've tried to sort of to set it up. So I think once we have the royalty generation side, essentially those transactions closed, should see substantially lower G&A on that basis. But we are also actually adding, even currently, to the team now. And we're trying to add 1 or 2 new people to the team to improve our technical capacity in terms of reviewing opportunities, which is a key part of it. We've also added someone full-time in IR in Canada, which we didn't have before. And that was a challenge for us through COVID, because we're a company that listed in Canada in 2020, but never made it over to Canada, or had only made it over to Canada once prior to sort of mid-2022, I think. So it's really important for us to be able to have someone in full-time in Canada going around introducing the story to people and actually getting the company out there, because we talked about the efficiency of costs and being a listed company versus being private. And we started as a private company, so we have the benefit of having seen both the positives and the disadvantages. And the positive of being private is you can be a lot leaner than you can as a public company. And particularly as you become a larger public company, and the regulations, there are more rules that apply to you, and there's a higher bar and threshold and some things that you have to comply with. And one of the, I think, advantages of being a public company, and the key one probably, is liquidity and your ability to have a liquid stock that people can trade and to attract far more investors than you can as a private company. But that is only worth something if you get the story out there and if you introduce the company to people. And actually, for that, I think we really tried to we tried doing it remotely, and I think we came to the conclusion that we needed someone full time in Canada who could help us get the story out there, as well as a lot of the team going backwards and forwards regularly to North America.
Do you need to do that though? Like, do you need to attract any more investors? Because when again at the beginning I said that something like 23% of the company is really out there, not in the hands of funds or long-term investors. So I mean, if you're not looking to raise capital immediately, why are you looking to attract new investors? I guess that would be the question.
Well, I think it's absolutely critical, because liquidity is particularly if we're using our equity with counterparties. Liquidity is a really important metric for them. And if we trade one share every year, then we're not a very liquid company, and people might have doubt in taking our equity. Whereas if we have good liquidity and we have a good turnover of shares, then it's easier for people to enter the stock because they know they can exit it as well. So liquidity is a key component of that. And I think when you've been a listed company for 10 years and maybe you've got a track record and as a listed entity and you're known to the market, it's easier. But I think as still a relatively new company, and having effectively been a lockdown company for the first 18 months or so of our existence, I think the onus is really on us to make sure we get the story out there. And I think for us, we have found that even some people in the mining industry who follow the royalty space over the last year, didn't know us. And so that was a good sign for us, that even if some of the professionals haven't heard of you, what chances are that the average investor's heard of you? So I think for us, it's about really getting the story out there to as wide an audience as possible and continuing to do that. And if we can do that successfully, then hopefully we'll have a very healthy shareholder base, which is, going back to that same word again, resilient, and it's diversified. And it's not just one or two big institutions, but it's also not just a retail shareholder base. It's a good mix of retail shareholders, institutional investors. It has liquidity. It has a mix of investors. We've got a very, very strong mix of investors currently from Europe, from Australasia, from the UK, from the US, and from Canada. I think much more so than your average North American company, and partly because of how we started as a private company and where we raised some of our initial money from. But I always think there's more we can do on that front to improve it. And there's always more you can do in terms of outreach to new investors. And the other side of it is you mentioned in the second part of your question about if you're not looking to raise money, why do you want to talk to investors? And I think for us as well, it comes back to that point around opportunistic and being flexible and nimble and agile. And for us, even if we don't have an opportunity in front of us today, we would like to be in a position where if we saw a $50 million opportunity tomorrow, we would have investors we've already spoken to who understand the company, who understand what we're doing, and we can go to them and say, look, this is an opportunity that really makes sense. It wasn't there when we spoke to you 3 months ago or 6 months ago. It's here today, and we'd like to take advantage of it, but we need to move quickly. And to do that, you need to build that trust, and you need to build that relationship, and you need to have investors who are familiar with the story in order to enable you to take advantage of those opportunities.
But I'm just thinking how to translate that to my 5-year-old brain. Does that mean you're going to be raising capital soon or not?
It doesn't mean either, to be honest. I mean, we've been doing this from day one. So there's been periods where we've done multiple deals and raised money multiple times, and there's been periods where we've done deals and we haven't raised money, and there's been periods where we haven't done deals and we haven't raised money. So it's if we ever stopped going out and talking to investors, I think we wouldn't be doing our job. It's absolutely core that we are continuously talking to our investors. And I think there's a really key difference here when you're thinking of a different example, when you're a private equity fund and you raise money from your limited partners and they have a 5 to 10 year timeline on the fund. And of course, you're going to be in constant contact with those investors. But during that period, you're not necessarily going out all the time and marketing yourself to new investors. You're really focused on deploying that capital. Now, in a public company that has no hold or no lockup for the majority of your investors, they can come in and they can come out as much as they want. And your share price is really a function of that supply and demand equation in the short term. And so that's where you can often get the value disconnects. If everyone wants to sell a stock, it can become undervalued. And if everyone wants to buy a particular commodity or a particular stock, or a story gets a lot of attention, in the short term, it can become overvalued because the demand is greater than the supply. And that's all about new investors and new money. So I think we're constantly trying to have a healthy liquidity in our stock for the benefit of our existing shareholders, as much as potentially for if we see an opportunity in the future to be able to move quickly and nimbly to take advantage of it.
Well, one way that you've been financing has been, again, as I mentioned at the beginning, through debt. And so your debt sitting around 30 million right now. And so the interest payment for the first half of the year was about 1.3 million. Annualized, that would be about 9% expense on the total debt outstanding, that's not surprising. I believe you're sitting at SOFR up to 3.75% on top of the SOFR, something along those lines. I believe that's what the debt is. But what are the plans there? Because that's obviously part of your expenses as well. Are you allowed and wanting to get rid of that all at once, or are you just going to keep paying it off as planned?
So we're very flexible on the debt in terms of going forwards, whether we pay it down or whether we continue to reinvest or even just increase our cash balance. I think for us, we started off when just before we listed, we had a material transaction. It was a Wang Yuan royalty, and we were trying to initially do it in conjunction with the listing. But when I say we're a small team now and we're a small team before the merger, we were an even smaller team before we listed. I think there were 2 people full time in the office, and we were trying to do a fundraise in a market we hadn't worked in before, reverse into an existing shell. We were trying to do an acquisition, the biggest acquisition the company had ever done, and a fundraise alongside it. So there was an awful lot going on and a lot of plates spinning. And we decided to put some of those plates down. And we took a credit facility from Sprott Lending, and we closed the acquisition of the Wang Yuan royalty prior to listing. And then we listed the company. With the proceeds from that listing, we paid down all the debt apart from $1. So the credit facility was still live, and it gave us the flexibility to pick it up again quickly if we needed. And we did use it again for the South 32 transaction, which was a deal that at the time was just slightly bigger than the actual company's market cap. And it was a mixture of cash, equity, and debt. And that facility, it enabled us, it gave us the flexibility to grow very quickly. And it gave us the flexibility to do it without using all our equity or without raising cash at the time. And so from the company's perspective, I think it's been very useful to have that as one of your options in the toolkit. And ultimately, we want as many options as possible. When we were a private company, it's hard to offer your liquidity in a private company where there's no exit and there's no trading, back to the point, and you don't have a credit facility. So it's really cash on hand, or you have to raise the money alongside a new deal. And that can be challenging because you can be talking to counterparties who they agree terms with you to sell a royalty. And then you tell them, look, guys, I have to go out now and I have to raise the money to do this. And there's no guarantee on if I can do it or how long it will take. So being in the position where you have a credit facility and you have undrawn capital and you also have cash, in our case now, means that we can go to counterparties and we can say, we would like to acquire this royalty and we have the funds for it, or we can use our credit facility in the short term to give you confidence that we can close the deal. And then it's for us to decide if we do a fundraise afterwards or if we don't, or if we pay it down with revenue, etc. So it gives a lot of flexibility in terms of acquisitions, whether or not you use it. In terms of where we sit today, we've drawn 30 million. We have the ability to go up to 40 million, and in some cases up to 50 million. We have about 10 million US in cash, as mentioned. I think that as you've seen interest rates going up a lot over the past year, I think that it's meant that the cost of debt has increased substantially, and that factors into our thinking. And I think that the timing to graduate from Sprott lending to National and CIBC it turned out to be very important, because as quickly as we were lowering the cost of our debt, so 4+, interest rates were increasing. So it was especially important to refinance that at the time. But yes, it's the cost of debt is significantly higher than it was, and certainly than I think people would have anticipated, say, 2 years ago. And that's always something that we've got to factor in when we're looking at new opportunities, which is, if we are going to use a credit facility for them, they've got to deliver a better return for us than the cost of that capital. And the cost of that capital on the debt side has gone up. So at the moment, I think we're fairly comfortable where we are. I think, as we said, we see a lot of good opportunities in this market. And I think our focus is on growth and growing the size of the portfolio. And if we are in a position where we have a lot of cash and we don't see opportunities to spend it, then I think paying down the debt is a logical point, particularly where interest rates are substantially higher today than they were 18 months, 2 years ago. So it's always, again, it's keeping one eye on the opportunities, and it's keeping one eye on the cost of capital and the debt, and balancing those two.
That makes a whole lot of sense. What is sort of the timeline you're working with here, though, of cutting all those expenses, raising the revenue and then turning profitable? What are your hopes and dreams here?
So I think in terms of firstly on the royalty generation side, which is the most active, that we're expecting one of the deals has closed straight away, and that was Egypt. And I think Ethiopia and Mali, some of that is in the hands of in-country regulatory bodies and authorities to sign off on the transfers. So can't put a specific timeline on those, but I think we're actively working on both to get them done as efficiently and as quickly as possible. So I would think that looking into it, I would think that in and around Q4 would be the point where we have officially closed off and partnered those assets and some of those teams. And so I think that's where we'll have probably, and we're just coming up to September now. So I think in the next couple of months, we'll probably be in a position where we have that materially lower cost base going forwards. And I think that's going to time quite nicely with our royalty at Bonachrome that is ramping up from about Q4. So I think in and around Q4, that's going to be the period where we've got an increase in revenue alongside a decrease in G&A that come through simultaneously. And that will really drive the margin expansion. And look, that is absent new royalties. It's not including any new deals we do or anything else. But as it stands in the portfolio today, I think that Q4 period is where we'll see some of that translate into reality in terms of financials.
Okay. What happens after that, though? Like, is dividend a reasonable expectation, or will the growth phase continue for a while longer? What are you thinking?
So it's an interesting side, but actually, as a private company, we did pay a dividend, and we actually built it into the constitution of the company that we had to pay. I think it was 5% of royalty revenue to shareholders as a dividend, and they could elect to take that in cash or in equity. And I think nearly every shareholder took it in equity at the time, but it was a point of principle. And as a private company, it was an important way for us to demonstrate from the beginning that we were aligned with shareholders and we were going to return capital. And when we came to list the company in 2020, and we had more revenue than we had, and we were sort of scaling up the company, we did a much broader roadshow with institutional investors as well. And I think the feedback we got from a lot of the institutional investors was, look, a dividend at your size, and granted we were a smaller company in 2020, But I think the feedback was a dividend at your size is less important and less material than achieving scale and critical mass. And so you should focus on reinvesting that capital into your portfolio, growing the portfolio, adding to your revenue. And as you do that, you will lower your cost of capital. And as you lower your cost of capital, then a dividend starts to make more sense. And the credit facility we just referenced is a really good example of actually being able to get to a point where we are lowering our cost of capital. And so it starts to make things like a dividend be a sort of more timely discussion internally. And so it's something that I think we've talked to it occasionally internally. I think we'll probably talk to it again in the coming months and sort of going into next year. But it is balanced too against the opportunities that we see and weighing those up. But certainly one of our features, and I think one of our defining characteristics, has always been an incredibly strong revenue generating profile, far more so than any of our peers. And so it is not an unreasonable question to ask that, would a dividend be a good way to highlight that? The fact that we can afford to pay a dividend because we do have a lot of cash flow as a small company. So it's definitely something we're talking about. I don't think we wanted to do it before we refinanced the credit facility, which we announced in December and closed beginning of this year, because we felt at the time that it was we had 55 million roughly of debt at the time, and it was a higher cost of capital. So refinancing it down to 30 million at a substantially lower rate plus so forth puts us in a position where we can have a sensible discussion about a dividend. So it is something that we're talking about, and it's a question of when the timing is right. But we'd very much like to at some stage put a dividend in place as a company, and as we grow and as we mature, it's a kind of thing I think our investors will expect to.
It does make sense that people would expect that from a royalty company for sure. Yeah. So we've talked about operational, we've talked about financial. There's one last thing that I want to talk to you about before I move on from being in front of your face for too long. I found an interesting slide in your presentation that shows that shows you I guess allegedly being undervalued on a P to NAV ratio basis, and I guess that makes sense given that your share price has been going down since you listed, I guess, despite again the company pretty much having changed completely as we've discussed. So why do you think the market is pushing you right now? I guess that might be a good place to take off the valuation talks from. Why is the market not seeing the value that you're seeing and that you're creating here?
So I think for context, I think we listed at $1.30 in July 2020, and we're about $1.20 today. So from where we're down slightly on that, and I think part of the challenge has been that we listed within 24 hours, I think within one day of the top of the market in 2020, and so there's the GDX, the GDXJ, I think has come off about 40% since we listed. And if you look at the royalty space, even some of the majors, even some of the biggest royalty companies have been flat or in some cases have come off slightly since 2020, which is pretty unusual. And in our case, again, with a portfolio that we've got a bigger asset base, we've got more revenue, we're more diversified, a lower cost of capital. I think in all those features, today, I think for our share price, I think we're excellent value. And I think the last transaction we did, where the counterparty took all equity in return for their royalty, was a good validation of the value that people can see in our equity today. And if you rewind a bit to the unsolicited takeover offer we received, which is approximately a 50% premium to where we are today, I think again it demonstrates that there's a lot of value in the stock that's there and in the asset base, and as we continue to grow it, we can add to that. As to the share price today, I think it's partly comes back to that conversation we had on liquidity and buyers and sellers, and we're in a market now where there's an awful lot of I think sort of lack of interest, if I can call it that, in the junior gold space. And I've heard it from a number of parties, and you can see it in a lot of junior development companies and exploration companies that have really suffered in terms of market and liquidity. So for us, I think, look, the really key things are delivering on what we said the merger would bring as step one. And we said that the merger would bring a lower cost of capital. We said it would bring a better G&A base. And we said that we could realize some value through the royalty generation portfolio alongside that. And I think that we've announced some of that, and we're going to see the fruits of it coming through in Q3, Q4. And alongside that, we've been more active on the BD front, adding new assets than we've been before. And that's partly a function of having a bigger team and being able to do more simultaneously. And if you look in the past week, I think we announced our Q2 results. We then announced the acquisition of the Arizona and Sonoran royalty with RCF. We then announced the transaction in Egypt with within 2Metals. So we've done two transactions in our quarterly results sort of in a week, and the Egypt deal was announced and closed on the same day. So it's certainly been busy, and we wouldn't have been able to do that without the team that we've got now, where we've got some of those roles moved in-house full time. So I think that's partly the benefit of where we are. And I think that as we go, I think that some of the assets will demonstrate that. And as that happens, I'd like to think we'll get rewarded by shareholders, because it is not often, and by new investors, because it's not often really, if you look back at the history of the royalty space, there are not many opportunities you see where there's a company of our size that have taken it from a startup, and this was genuinely a startup in every regard, through to where it is today with the portfolio and the maturity of the portfolio that we have. And I think to be in a position where we are, I think it's really good value. And when we're not in a closed period as management, I think we do like to buy shares. And I bought some personally, not so long ago when there was a brief break and we weren't in a closed period. But unfortunately, when you're very active on transactions, you find yourself a lot of the time in a closed period, unable to buy shares. Mm-hmm. But historically, we've been buying shares, continue to buy shares. I think the shares I bought recently were the cheapest shares I've been able to buy in the company since we've gone public. So, I definitely believe in where the story is, and our biggest shareholders have been incredibly supportive of us. And if you look at the institutional shareholder base we have, it is, again, really impressive for a company our size to have some of those institutions behind us. And that is a testament to the quality of the asset and the disciplined approach we've taken that we really believe will add value as we build the company out.
You did indeed buy some shares. It was late last month, I believe. Yeah, it was in July, late last month, that you were buying at around the levels that we're sitting now. So one order was 125 and the other was 119 that I have on here. So that, that is true. All right, Fred. Well, I'm about to let you go. Last thing that I sort of always ask at the end is, nothing is perfect. And what if you had the opportunity though to make it perfect? Like, what if you had a magic stick and you just wave it and you make three risks really go away? What would you wave the stick at?
If we could make 3 risks go away.
Yeah, like something that maybe particularly keeps you up at night when it comes down to specifically, obviously, Elemental.
Okay, so risk number 1 is actually having, and it might not be one you'd expect necessarily from the outset, but I would actually say having the management team who, if I get hit by a bus tomorrow, we've got enough strength and depth, and we've got a good enough management team with enough experience that the company will keep running seamlessly. And that's not just important if I get hit by a bus. It's actually quite important if I ever want to go on holiday as well and be able to turn my computer off and not worry about things. And I think when you start from a really inception and startup, one of the challenges is you're wearing multiple hats a lot of the time. And with the merger, I think one of the things that was quite exciting about it was being able to get really good caliber people, attract good caliber people to the company, and strengthen that management team. So that's been really fun and really enjoyable. And it's also removed a big risk. because we've got better people on the team, more experience in-house, more expertise. So I think continuing to do that's one risk that makes me sleep well at night if I know that we've got a great management team in the company. I think the second feature I'd love to see is I'd love to see an even larger, more diversified portfolio. And I can say that with experience, because I can remember in the early days how stressful it was when we had one royalty producing, or we had two royalties producing, and we were a private company, and we had no access to the capital markets. And if there was some disaster on one of our royalties, we had no diversification. And so I've literally lived it. And I think I probably said at times to my wife, how much easier it was to sleep at night, knowing that we'd diversified our portfolio further and built it out. So the second one is management strength and depth, number one. And number two is diversifying the portfolio, not just in revenue base, but that always helps, and adding to it. And I think number three, in terms of what risk would I take away, I think as well is reducing that debt and that leverage. Because when you're trying to build a business for the medium and long term, you really want, and I've used the word probably a few times in this interview, but resilience. And I think being in the strongest position possible and being able to take advantage of opportunities. And some of the best deals that I think have been done in the royalty space, some of them have been done at times of dislocation and in difficult markets. And being able to take advantage of that is having financial flexibility as well. So being as strong as possible on the balance sheet, continuing to strengthen the balance sheet, and maybe that's more credit facilities, less leverage, more cash flow, more cash on hand, better shareholder base, all of those things. I think those three risks, those are the three ones that I'd love to see addressed.
Seems like you've thought about those before. And just
it was a good question. Hadn't thought about it, but then when you said, I think all the memories started to come back, and could think some of those that we've lived through.
I like ending it that way because, as most of you will know, I don't send questions up front to the companies, and often companies don't expect the question to be asked in that way, as a magic stick. What would you remove? And oftentimes they would say, well, I wouldn't remove anything, but I don't let them go that easily. So yeah, thank you for answering that. Yeah, I'm mostly out of questions. I mean, I can keep talking to you for a long while. We've been talking for a while, so I apologize for that. What am I forgetting? What am I failing to bring up that you came here hoping to talk about?
I think it's I think one of the key things I'd flag to people is look, it's the hardest thing in the royalty space, and this doesn't just apply to Elemental Altus, but across the board. The hardest thing in the royalty space, the holy grail that people are looking for, is good quality producing assets. And that is the backbone of the company. And I think when some of the major royalty companies started, people often said, those companies, they look expensive. They're not trading at a big discount. And I think they've proven over time that the optionality you can get on good quality producing assets, where you have optionality uncapped on commodity price, on exploration upside, on technological success, on all of those factors, that has a real value in it. And I think for us, the most important thing has always been getting that foundation of producing assets. And it has been really difficult, and it has taken time and discipline and patience and perseverance. And I think now we've got there, we're in a place that we've never been before, where we can afford to invest in a difficult market in multiple opportunities simultaneously. And that's what we've been doing over the course of this year, and we'll continue to do. And the way we have got this far is by doing good quality, sensible deals that have added value. And if we can keep doing that, we should be very well placed to keep growing the company, both in terms of value for shareholders, but also in terms of the optionality and upside we're building in for shareholders at the same time.
Thank you so much for this overview, Fred. I hope I'll be able to follow up with you on some of these things that you've told me here today. But thank you so much for investing your time with me.
Much appreciate the opportunity to chat, Antonio.